Okay. Hi, good morning, all. So we have Dr. Tushar Podar with us. He is a founding director of Meghnad Desai Academy of Economics. And Meghnad Desai Academy of Economics runs two postgraduate diploma courses, one in economics and the other one is in data science and finance. Okay. I thought I'll just briefly introduce to you what Meghnad Desai is all about. And our chairman of the academy is Lord Meghnad Desai himself, and he's in town. He's going to meet our students for the convocation. And Dr. Tushar Podar, he works from London, and I think Geeta, would you like to introduce him?
Sure, my pleasure. So, as Dr. Dapke said, we have old ties with old people. Dr. Dapke is our very own next door KC College Vice Principal, and now she is doing her second innings at the Meghnad Desai Academy of Economics. And of course, Dr. Tushar Podar is again a known person. My own colleague who was traveling. Would work with him practically every Saturdays. Tushar would drop by college, and we had Dr. Indu Shahani also collaborate with Lord Desai, and Lord Desai had come for something which was very student oriented, which was a lifelong learning program of the University of Mumbai before we became HSNCU. So we would give students those 10 marks, and we would have it tied up with a research cell where they would do real world things like caring for the elderly, aged, and Lord Meghnad Desai had inaugurated that program. So our ties run old and deep. So we have Dr. Tushar Podar, who is an alumnus of the prestigious London School of Economics, from where he has earned his doctorate. He is the managing director and macro strategist at the Wellington Management, which is a $1 trillion fund. He works and invests in 80 countries around the world, including advising and investing in several governments of Sri Lanka, Indonesia, Middle East, and South America, amongst others. He is also a part of the emerging markets debt team, where he researches and invests in countries in Asia, Middle East, and Eastern Europe. Before that, he had his innings as the chief economist at Goldman Sachs India for a decade, and was also an economist with the IMF in Washington. So he has been globetrotting from the US to England, and now he's here. We are fortunate to have him on the early morning before their convocation at Meghnad Desai, and he is going to speak on a very interesting topic, very well titled Goldilocks or Recession Outlook for the Global Economy. So I welcome Dr. Tushar Podar, and over to you. Thank you.
Thank you so much, Geeta. That was really, really effusive. And as you said, the ties with HR run really, really deep. It is where we began the journey for the Meghnad Desai Academy with Dr. Indu Shahani and with several faculty members of HR College. And it's great to see that connection go deeper and deeper every year. So really looking forward to this interaction with the students. Thank you very much for joining. I think you guys are privileged to be part of HR College. And you have very exciting opportunities ahead of you. This is a great time to be studying and entering the workforce. There's so many opportunities and changes. But I thought I'd talk a little bit about what the global economy looks like, to give you a global context, because you get a lot of news about India, you get a lot of news about local news, but it's really important to have a global context. As citizens of the world, you will be called upon to understand, evaluate, analyze, and comment on the global economy as students of economics and other disciplines. So I thought I'll give you a quick tour of what's happening globally to the large economies of the world, and then open it up for questions and see what kind of issues that that you might have. But let me start with a question myself. How many of you know what Goldilocks means? There is a chat in the Zoom session. Why don't you write down, what do you think Goldilocks means? I think it'll be interesting to see if everybody knows what Goldilocks is and what it means. If you don't know, keep it to yourself. Somebody says don't know, so then don't answer. Who knows what Goldilocks is? Does anybody know? Has anybody read the story of Goldilocks and the three bears when they were growing up? Pratham writes, economy where the growth rate is moderate. Excellent. That is exactly what it means. Anybody else? Ideal state of the economy, says Utkarsh, and that's right. Growth rate is just right. Okay, very good, very good. Yes, where there is full employment, says Umang. What about, nobody has mentioned about inflation. What does Goldilocks mean for inflation? Can anybody write and say what it means for inflation? Inflation will be lower. Moderate inflation is the one. Yes. I think a number of you have got it right. So if you remember the story of Goldilocks and the three bears, Goldilocks happens to chance into this house of the three bears, and she tries the first porridge and it's too hot, and then she tries the second porridge and then it's too cold. And then she tries the third porridge, which is just right. And then she goes up to the room and she goes to the Papa Bear's bed, and that bed is too hard. Then she goes to Mama Bear's bed, and that's too cold or too soft. And then she goes to the Baby Bear's bed, and that's appropriate and just right. So that is exactly what we think about when we talk about economies. That is the goal of policy, is that an economy should be just right. It should be growing where it is not too hot, because what happens when it is too hot? It leads to higher inflation, right? When demand is very strong, what happens? People are buying lots and lots of things and the supply is not keeping up. That leads to higher inflation. Similarly, when an economy is too cold, that means that nobody is demanding anything. You're not going out and buying cars and washing machines and motorbikes and movies and so on, and the economy is too cold. It doesn't grow. And that's also not something that policymakers like, right? It's not good for an economy when things are too cold. So Goldilocks is when things are just right, it's growing at a rate which is sustainable. Inflation is relatively moderate, and employment is relatively high. And everybody is satisfied then, right? Of course, it's impossible that everybody has a job, but most people are satisfied. So that is the goal of policymakers, is to try to get economies which are moderate in growth and moderate in inflation. It should not be overheating, and it should not be very cold either, right? So I hope that's clear what Goldilocks means, because that is the goal for a macro economy. Now, just let's go down and see how economies are doing. And let me start first with the U.S., because that is the largest economy in the world, and it is it has had a bout of very high inflation, the highest that we have seen since the 70s. We are also seeing one of the largest increases in interest rates that the US has seen again in over 30 years, right? Where interest rates have gone from almost zero to now 5.25%. So there has been a very large and sudden jump in both inflation and interest rates, and that is leading to some slowdown in the economy. Now, there is a lot of debate as to whether the US can slow down and continue to grow and have low inflation, or it will run into a recession. And every time we see an interest rate increase like this, or we get a yield curve which is inverted. What do I mean by yield curve which is inverted? It is the difference between the long end of the yield curve, which is what is the market expecting interest rates to be in 10 years time versus where interest rates are now. When yield curves are inverted, which means that market expects interest rates to be much lower in 10 years time or 5 years time than where interest rates are now, then that can signal a recession. But this time it is not. The economy continues to grow at 2.3, 2.4% in the US, while inflation seems to be coming down. Does anybody know where inflation is in the US right now? Who's read the financial newspapers and is aware of what is happening globally? Can somebody tell me where inflation is? I'll give it 10 seconds, 15 seconds to see if there's somebody, and I don't want you to research on Google and come up with the answer. That's not the point. And if you don't, that's fine too. Okay, great. There's somebody there. Arjav, he says 3%. That's right. It's at 3%, and it's come down from over 6.5% at one point. So inflation is coming down, and this is not a country which is used to high inflation. More interestingly, we look at month-on-month inflation because that is important. What you are talking about is year-on-year inflation. What inflation is relative to what it was a year ago. But what we should look at is how is inflation trading month-on-month, which means every month, how is inflation moving? And that has come down to only 0.2% month-on-month. And here I'm talking about core inflation, which is really what we care about. So core inflation, which does not include food and energy, is down to only 0.2%. And that means that the economy continues to grow above 2% and inflation is down to only 0.2% month on month. You know, if you annualize that 0.2%, which means that you look at what that means for the full year, then inflation is only 2.4% in the US. So by all means, that's moderate. So an optimist would say that the US is moving towards a Goldilocks economy, right? They are growing, inflation is moderate, and the most important thing, they are creating thousands and thousands of jobs. Every month, there's a lot of jobs, right? So that job creation is really important because that means that people are able to work, they're able to spend, and that is, you know, something which is that policymakers want. You want people to have jobs. So what can change this dynamic, right? We're looking at inflation and growth data now, but how can that dynamic change? That dynamic can change when the interest rate increases that we have seen so far leads to a sharper slowdown in activity, right? In growth, in demand. That is something that worries us, is that because interest rates have been raised from 0 to 5.25% to 5.5%, within a year or within about 18 months, that the impact of that is yet to be seen. What happens when you have higher interest rates, right? People's mortgages, the housing loans become unaffordable. People are not able to borrow. Yes, somebody says they start defaulting on loans. You know, banks stop lending because the interest rates are so high that people don't want to demand more loans. Companies don't demand loans, right? Yes, that's right. Yes, says money supply decreases, right? Because there is a direct link between interest rates and money supply. So when interest rates rise, everybody reduces demand. Demand comes down. Companies don't invest more, right? Because it's more difficult to borrow. Let's say you want to invest in a business, right? If somebody here wants to be an entrepreneur, you want to invest in a business, the interest rate went up by 500%, right? Or 500 bips. If you could borrow at 0% 2 years ago, now you're borrowing at 5.5%. So how are you going to generate enough income to meet your interest payments, right? So you stop borrowing, or companies reduce their borrowing. Households reduce the home loans that they take or the loans that they take to buy consumer items. if any of you or your parents are borrowing to purchase cars or anything else, right? That becomes more expensive. So you reduce that. So that's why interest rates have an impact on activity. It slows it down. And we are probably in the first innings of that. We are seeing some impact of that on growth, but it has not been very strong. It has not been as strong as anticipated. And that is why growth continues to chug along at 2.4%, whereas inflation is coming down. Or, somebody mentioned some other numbers. I'm talking about core inflation. That's what the central bank cares about. That and overall, the trend is that the month-on-month sequential change is very positive on inflation. Now, what does the central bank or the Federal Reserve do in this situation, right? On the one hand, they see that inflation is coming down. On the other hand, they see that growth is going okay. But there is a third element that worries them. And that element is that employment is very strong and wage growth continues to be high, right? So why should a central bank worry about that? If all of you start getting jobs and get high wages, what happens eventually, right? What happens when everybody starts getting a big wage increase? Yes, demand increases. You go out and buy more. You spend more. Exactly. Thank you, Piyush and others who are mentioning this on the chat. Aman says you spend more. That's right. Sanskriti says demand. Yes. So aggregate demand is going to rise. And those who remember your aggregate demand and supply curves, if aggregate demand moves up or moves out, and remember it's a downward sloping curve, what happens to prices? Prices will go up. So that is something that the central bank is worried about. They are worried that because wages continue to rise, demand is going to rise, and that's going to lead to higher inflation. And that is what they want to control. They want to control inflation. However, the central bank also does not want a recession, right? If they tighten too much, if they increase rates too much, then employment might fall so much more that the economy goes into recession and lots of jobs are lost. So that is why it's not an easy task to be a central bank governor, right? You have to be very careful. You have to be very, you have to calibrate your moves based on data and information. What you read in the textbooks about demand and supply, the central banks and governments have to deal with on a daily basis. They need to monitor it. And as economists and students of economics, you guys also need to understand the impact this could have on the overall economy. So that is why the Fed is calibrating policy. In the last policy statement, the Fed said, look, we are going to increase interest rates by 25 bips to 5.25 to 5.5, but we don't know what we're going to do next. We don't know if we are going to hike or we are not going to hike. We don't know if we are going to cut or we are not going to cut. They are waiting for more data. They want to see whether the economy continues to grow, whether inflation continues to be stable, whether employment or wage growth does not accelerate from here. Wage growth is beginning to come down, but it is a lagging indicator, right? By lagging indicator, I mean that it comes after everything else. It's not a leading indicator. It doesn't predict things, right? So they are waiting for data to evaluate. But so far, it looks like the US economy seems to be moving to a Goldilocks situation or a soft landing, what we call neither too hot nor too cold. That can change very quickly. And if the interest rate increases are very high, or the impact is going to be felt in the banking system and in companies and in the real estate market, then the whole economy could go into a recession. Now, the other thing to worry about is that there could be shocks to inflation. Okay, and what are those shocks? Can anybody tell me what shocks can come on inflation? One is the demand and supply gaps that we are seeing, right? But what are the other shocks that can come to inflation? Okay, wars, yes, wars increase inflation. Technology, yes, Shubhay, it leads to a lowering of inflation over a period of time, because as technological advancements happen, for instance, if you're buying a lot of things on Amazon, prices get lower. But what else? More money printing, financials. There's one big shock that nobody has talked about, which has a direct impact on inflation. Natural calamity is one. Okay. What else? If you think about the case in India, what is the largest driver of inflation in India? Somebody says Diwali. Corruption. Okay. What has happened to tomato prices in the last 2 months? Have you guys forgotten? Food. Shocks to food. Right? That is the biggest impact on inflation. It affects the most people. Right? And food and vegetable prices are not determined by the central bank. They increase because there is a weather shock. Right? So those are shocks that happen everywhere around the world. You must understand that this is not a normal event. When tomato and onion prices go up, that's a shock to inflation. What else? Okay, I talked about food and vegetable prices. What are the other drivers of inflation? What can be a shock to inflation? Okay, you guys need to brush up. What about oil? Yes, coal, energy. It's a huge input to everybody's consumption basket. Basic raw material. Now you guys are getting it. Very slow. Come on, wake up. 10:30. Raw materials, energy is a huge input into inflation. In fact, the last 18 months, we saw massive energy price shock when Ukraine was invaded by Russia. Oil prices went through the roof, and that is a big cause of inflation. Similarly, when oil prices fall, inflation comes off. Your petrol prices come down, your diesel prices come down, your kerosene prices come down. Okay. Metal prices come down. Everything, all the commodity complex starts coming down, and that is very good for inflation. But these are shocks to the system. So remember, when we talk about inflation, it is not just demand supply of aggregate supply and aggregate demand. You also have to think about commodities. You have to think about food. You have to think about raw materials. All of that has an impact on inflation. And that is what the Federal Reserve is watching. If there is a big oil price shock and oil prices have moved up about 20% in the last 2 months, then they are going to be worried about inflation again, right? So inflation is something that can be affected by shocks, and central banks have to be always mindful of that. In fact, a lot of inflation comes from shocks to the system. Okay, so I've talked about the US. There's a few questions coming up, which hold your horses. Let me do a quick run around the world, and then I'll start answering your questions. The first point I made is that the US seems to be headed towards a soft landing if data continues to be like the way it is. It's in a Goldilocks situation, even though interest rates have been raised, but the final word on this has not been written, because we don't know the interest rate impact of the large interest rate increases, how much demand is going to fall, and we don't know what kind of shocks, commodity price shocks are there in the system, which can raise inflation and therefore cause the Federal Reserve to increase interest rates again, which can cause another slump in demand. Now let's go to the opposite side of the world. Okay. Can you tell me one large country which is in deflation right now? Anybody who's been reading the papers will know. Okay, good. Piyush, Pratham, good guys. Okay, China is in deflation. Why? China is in deflation because the economy has just not picked up after they changed the COVID restrictions. The animal spirits of the people and businesses have been reduced. Consumers are not consuming, right? Businesses are not spending. And so China is growing slower than it should be, and it is in deflation, a very, very different problem to what the rest of the world is facing. The government is trying to stimulate activity by giving subsidies and spending and cutting interest rates, but so far it does not seem to be working. Can anybody peel under the layer and tell me one reason why that is the case? Why is China suffering deflation? Piyush, that's great. You said that they are facing demographic problems. That's a big one, right? that China is aging. And so, but that is a slow moving variable. It takes time to play out. It takes 10, 15 years to play out. What are the other reasons why there is deflation happening? Unfortunately, people are not investing, Aman. They are not, that is the problem. Pessimism is a good response, Shubhay, that people are pessimistic. So they're holding back consumption. They're not traveling. They're not consuming. They're not spending as much as people thought they would. There is some increase. Okay, the best answer that I got is from Arjav, which is that there is a real estate crisis in China. Good guys, you guys are reading. I like that. Ankit also said that real estate bubble just popped. That's very good. Okay, you must know what the second largest economy is doing in the world, right? Because it has a huge impact on everything, including commodities, including demand for India and everything else. You cannot be understanding the global economy without understanding the two largest economies, the US and China. And so if you're not reading about it, change that habit now. I hope after this talk, you will change your habits and you'll start reading much more. So that's right. China has a real estate bubble, which went on for 15 years, and that has popped. It's been down for 2 years now. The government is trying to resolve those problems, but the local governments, which depend on revenues from land sales, they depend on stamp duty and registration fees from land sales. They are suffering because nobody's buying land, right? And if you are a property owner, and if your property is down 20, 30%, you don't feel like spending. You have a negative wealth effect, right? You feel poorer. So people are not spending because they feel like they've gotten poorer because of this real estate crisis. So the real estate bubble bursting is a big drag on the economy, and that's going to take some time to play out. Okay. Another reason is that the government cracked down on businesses, especially technology businesses. They closed down the education sector, the online sectors. They cracked down on Jack Ma. Some of you will know who Jack Ma is. He's the founder of Alibaba, the largest internet firm after Amazon. And as Lakshita says, and that's a great answer, exports have decreased. Because the world is consuming less, exports are going down from China. So China is suffering from exports falling, it's suffering from a real estate bubble collapse, and it is suffering from a lack of confidence on the part of the consumer and companies. Confidence is very important for people to spend, right? And so China is in deflation and growth is slower. So on the one hand, we have the US, which is looks like to be in Goldilocks or soft landing. And on the other hand, you have China, which is much slower than expected. So there are two forces which are moving in the wrong direction, okay, for a country like India or for other countries who are all dependent on some ways or the other or connected to the US or China. Now I'm going to talk about Europe. Europe is going through also a deep slowdown. It is no longer it's not a recession yet because wage growth is still strong, so people are still consuming, but it is just chugging along at 0 to 1% growth rates, very, very low growth rates. Inflation is still too high. Central bank is still hiking rates. So Europe is going very slowly, and that is going to continue for at least a year's time until the central banks start thinking about cutting rates or inflation comes down. Sanskriti says riots in France. That's a small issue, Sanskriti. That's a small issue in a small part of France. So that did not have a huge impact. It is a small shock, but doesn't have a large impact. The bigger impact is that there is a slowdown because interest rates are higher, but also because Europe is at war, right? You guys know that much more important than the riots in France is the war in Ukraine. It is a war on Europe's doorstep. Okay. Yes, Riva, Russia's invasion of Ukraine means that all of Europe is at war. Energy prices went up for everybody, right? Russia is the largest supplier of raw materials and commodities to Europe. It doesn't only supply oil, it supplies gas, it supplies wheat, it supplies copper, it supplies aluminum, it supplies a lot of commodities to Europe. So all of that has come down. Russian capital has gone away. Russian investment, trade has gone away. So plus they are investing in or putting weapons in Ukrainian hands. So there's a lot of defense spending that Europe is under. So Europe is going through a tough time because it's at war. It's fighting with Russia on the side of Ukraine, and everybody from Germany to France to Italy to Spain to the UK, they're all involved in that war. And that's why Europe is slowing down and in nearly stagnating. So what I'm trying to paint is a global picture which is not very strong in terms of growth, right? The US is just barely chugging along at 2%. China is slowing down, much lower than expected. Europe is actually stagnating and might even go into recession at some point. So the world economy is in very slow growth. Inflation is only beginning to come down. What can change this is interest rates, right? If central banks who are now increasing interest rates start cutting interest rates, right, then that can boost activity, that can stimulate activity again. But that's not happening in most of the world right now. What can also change is that trade begins to, or imports and exports start increasing again rapidly. But that again is not happening because of the China slowdown and slowdown in Europe. Now let me talk about some other countries in emerging markets and tell you a little bit about what's happening in the rest of the world. So let me start from South America. South America is fighting inflation from Brazil to Argentina to Chile. So inflation is beginning to come down there, which is allowing them to cut interest rates. In some places, interest rates are 11, 12, 13%. They also had inflation, which is very high, but now it's beginning to come down, and that's very good. That means that activity can restart there. Okay, so that's a good thing. Now, moving more towards moving east, Eastern Europe is still facing Poland, Czech Republic, Hungary. All of these are still facing the implications of the war, but at least they've got inflation under control. So now they're beginning to cut interest rates. And that is important because then the whole cycle can restart, demand can restart again. The countries that are doing really well are the ones that benefit from oil price increases, right? Which countries are those? Can somebody tell me who's benefiting from oil price increases? Yes, Middle East in good bold letters, Saudi. Yes, these countries are booming. Dubai is booming, as you must have read. UAE, the Saudis, Qatar, all the Emirates, they are all booming because oil prices are high. They can boost demand. They can do whatever they want, right? That is where they are investing. So as all of you have said, the OPEC countries are doing very well. Growth is strong. Okay, inflation is beginning to come down. Anyway, they don't pass through oil price increases there, because they produce so much, they can keep oil prices very low in their own country. So these countries are doing fine. If I go to the former Soviet Union, these are all oil producers, places like Kazakhstan, Azerbaijan, they're all oil producers, so they're also booming. They're also doing pretty well. If you are an oil producer, right, and if you're a commodity exporter, then this is a good environment for you. At least the last 3 years have been pretty good. Unfortunately, that's not the case for South Asia, right? In our borders, both Pakistan and Sri Lanka are going through a financial crisis. Both of them suffered from very high oil prices. They had a loss of FX reserves. They had very high inflation, low growth, and so they are struggling to repay their debt. Sri Lanka has already defaulted. Pakistan could be next. They're both facing balance of payments crisis. Okay, and that's largely necessitated because COVID stopped all activity and exports, whereas imports went through the roof because of higher oil prices. Now, luckily, India is not in the same boat. While oil prices is hurting India, and India is also beginning to slow down, but it is not that impacted. There is domestic demand. Growth is still running around 6% if you hear the central bank. I hope you guys heard or listened or read about the RBI meeting that was 2 days ago on Thursday. Does anybody remember what the inflation forecast is of the RBI? On the 10th of August, they made an inflation forecast. Very good, 5.4% for this year. Okay, it's not low, but it is high, but it is not extremely high either. What is the growth forecast of the RBI? Dhruv, I will come back to your questions. Those are good questions. Let me come back to that. But can somebody give me a growth forecast for this year that the RBI gave? Okay, Arjav 6.5. Right. So the RBI is fairly confident, and India is one of the fastest growing countries. I'll come back to India because that's always something that you guys hear a lot about. But let me now cover Southeast Asia. Southeast Asia is also doing reasonably well. Indonesia is growing at 5%. Thailand should grow around 4% this year. Malaysia should again grow by above 4%. Philippines should grow by 4-5%. So all of these economies are doing fairly well because they've not had a big inflation spike. With tourism coming back, they're doing fine. Domestic demand is strong. However, they're still not booming because export growth is very weak. Remember your demand equations, C plus I plus G plus net exports, right? So net exports are negative almost everywhere in Southeast Asia, whereas consumption and investment continues to be decent, right? Both private sector and public sector demand, domestic demand, C plus I plus G continues to be fine. So these countries are going to continue to chug along. So, parts of Asia are doing reasonably well. Growth is fine. Somebody asked about Japan. Japan is finally beginning to grow, and it also has inflation. Remember, Japan had a decade of deflation, and now they've got inflation, which could reach 2% or above that. The Central Bank of Japan does not allow the yield curve to change. That means that the 10-year bond yield in Japan is fixed by the central bank at a very low rate. It is called yield curve control, or YCC. After this talk, you guys go ahead and read what YCC is. It's very interesting. Okay, if you want to understand what central banks can do, Japan is a perfect case. Read much more about Japan because it's so unique. And it's such a fascinating case. They control not only the policy rate, right, like the RBI does, but they also control the back end or the 10-year bond yield. Okay, and they do that so that interest rates don't go up too much, and there is more demand. So it's a stimulative policy. It's a policy to boost activity, and that sort of flat yield curve is something that now they're beginning to change because inflation is coming back, right? Look, the question is how Japan manages to curb inflation so much. Well, it's a deflationary country. You are living in an inflationary country. That does not mean that other countries have inflation. There are many countries in the world can go through deflation, and Japan is one of them. So that is why I want you to read more outside India, because then you understand that inflation is not necessary or universal. Inflation happens to a few countries like India, which are growing fast, where demand is strong. In many countries where demand is weak, there is deflation. Another country which suffered from deflation for many years was Russia, right? Because it produces so much, there's so much of supply and demand was not there, the prices were actually falling. Japan suffered from deflation for many years. So deflation can easily happen. Okay, it's not an oddity. If you read more about the world, then you'll realize that inflation is not something that happens everywhere. It happens in India, that's all you've seen, but that does not mean that it happens everywhere, okay? Governments and central banks worry more about deflation because deflation means that people don't spend, they don't stimulate activity, job growth falls, people get unemployed, and it creates a negative spiral, right? You don't want to spend because you think that prices are going to be lower next year, right? Why would you buy that car if it's going to be 20% cheaper next year? Or why would you buy this big house if you think that you're going to get it 5% lower next month? So let me wait for a bit. I'll wait for a bit and price will go. And if everybody waits, then nobody spends. And that creates a negative spiral. Okay. So that's what's happening around the world from a cyclical standpoint. Some parts of the world are growing. Some parts of the world are very slow. Deflation is a problem in some countries, but much less so because the commodity price shock. And now I think I'm going to pause, take your questions. And if you have any questions on structural issues or long-term issues, very happy to do so. So post your questions now. Okay, Ankit says, sir, what do you think of the African region that has started defaulting on Chinese loans? Yes. So, not all of China is defaulting. There is a lot of restructuring happening, and I'm deeply involved with that because we are involved in the restructuring of loans for Sri Lanka as well as Ghana. So what happened is that the Chinese government, Export-Import Bank, central bank, and policy institutions lent a lot of money at high interest rates to Sri Lanka. When they did that, that meant that the ability to repay for a country like Ghana was much more difficult. So their debt became unsustainable. They not only borrowed from China, but they also borrowed from the World Bank and IMF. They also borrowed from other multilateral agencies. They also borrowed from bilateral countries. The debt became unsustainable when growth fell and interest rates became too high, as is the current situation. So Ghana is going through a big restructuring of its debt, both domestic and external, as is Sri Lanka. We are trying to find solutions where the Chinese are able to take some haircuts, which means that they don't have to take that if they lend $100, let's say, okay, and I'm not going to give you the exact numbers because it's in some ways part of a confidential discussion with the authorities. When the if China lends $100 to Sri Lanka and charges 5% interest rate on it, Sri Lanka is unable to pay that 5%. Then what you can do is you can extend the maturity. So what the Chinese government is doing or discussing is, okay, don't pay us this year or next year or in 25 or 26, but start paying us after, let's say, 27. So that is rescheduling of the debt, which means that the interest payments I don't pay for 3, 4, 5 years, and then I pay, longer term. Another way to do that is to reduce the interest rate itself or the coupon payments. If I was supposed to pay you 5%, then Sri Lanka pays 3% or 2%. So that is another way of reducing the debt burden for Sri Lanka so that, that they are able to repay the Chinese and India and everybody else that has lent to them. It's called debt rescheduling. That happens every time there is a lender who's unable to pay a borrower who's unable to pay the lender. And that is a problem. So I think this also talks about the question about, what Sri Lanka and Pakistan can do. First of all, they need to restructure their debt properly. Second, right, they need to take hard measures, which means they have to cut fiscal deficit and reduce their debt levels by reducing their fiscal deficit. If the government is borrowing less, that is a solution. Third is that partly what they've done already is devalue the currency, and that can lead to better exports and lower imports. Both countries have done that. They've devalued their currencies. Fourth is stop printing money because that leads to inflation. So they can control inflation. So first you got to get the fiscal right, which means the government, what happens? Let's say you're a household which is bankrupt. Okay. First thing you have to cut down is your spending, right? You can't go out and go to a fancy restaurant and eat if you're bankrupt. You can't go and buy the best clothes if you're bankrupt. You got to cut down your spending on the fiscal side. So that's what they're trying to do. Second is you got to find some source of revenues. Okay. So you got to start taxing the rich. You got to start taxing the people who consume oil, because who consumes the most oil? It's the rich. Okay, so that's what you have to do. The third thing that you have to do is to boost exports, because that's how you can get foreign exchange to pay for your imports. So, and the fourth thing you have to do is you have to stop printing money, right? Because that leads to inflation. So these are some of the measures that these countries have to take, which they are beginning to take now with the IMF's advice. You can go on the IMF's website, pull up a country report for Sri Lanka and Pakistan and read everything that they're doing, if you're so interested. And that will tell you exactly what the problems are and what they are doing. So then next time you go into a party and want to have a conversation about what is happening in Pakistan, you appear intelligent, right? Because you've read the report, you've done some research on it. So I would encourage you to do that. And you will sound very sensible if you've read even one report. It's going to take you a few hours to do that, but you'll come out, a lot more intelligent about the problems that are happening in Pakistan and Sri Lanka. Okay. Other questions? Sanskriti says, "Sir, America printed nearly $6 trillion in COVID to pump up asset prices. So is the World Bank not worried about the debt which will virtually never be paid?" So that's two questions in one, Sanskriti. One is America printing money. Okay, that is called, they were expanding their balance sheet. You're right. They expanded their balance sheet massively by printing money, called QE. And now they're reducing it. They've already reduced it by $1 trillion, and they're going to continue to do it every month. So they are basically saying that we are going to do what is called QT, quantitative tightening. They're going to reduce the money supply. They're going to reduce their balance sheet because they've been extending the balance sheet for the last 15 years, especially under COVID. And that policy, unfortunately led to very high inflation in 21, 22. You can't print so much money and think that it's not going to have an impact on inflation, right? And that's exactly what we had. And we can delve into the reasons why they did QE so much, or why that led to such high inflation, and what are the factors that are driving inflation. But I'm just telling you that, just giving a snippet of some thoughts, is that the printing or the balance sheet expansion of the Fed and other central banks was a direct cause of inflation globally. Okay. It also led to artificial increase in asset prices and higher debt, which you're absolutely right. So that still needs to be worked out. Asset prices need to fall gradually globally as that money gets sucked out. And as we are living in an environment where money is becoming much more expensive, right? Because if you were able to borrow at 0% 2 years or 18 months earlier, and now you're borrowing at 5.5%, money is more expensive. It's much easier to put your money in a fixed deposit, right? In India, the fixed deposit rates 2 years ago were 4.5%. Now it's 7%, right? So money is becoming expensive. You don't want to hold cash. Might as well put it in a fixed deposit, get 7%. And imagine what happens when it goes from 0 to 5 in the US. So money is becoming expensive, not only through interest rates, but also through central banks taking back these dollars that they have printed. And so that will have some impact on asset prices. Yeah. And the debt problem is exactly what I was talking about, is that it needs restructuring. It needs countries that have lent to these governments to come together and say, okay, we will give you time to reschedule, reduce your interest payments over the next 10 years, reduce when you have to pay. Don't pay us now. Don't pay when you're ready to pay. That's what you have to do. Otherwise, you get nothing, right? If you say, no, I need my money now. If China comes and tells Ghana or Sri Lanka, I need my money now, Sri Lanka is saying, I'm bankrupt. I have no money to pay you. You can do whatever you want. What are you going to take? You're going to come and occupy our country. What are you going to get? So there has to be, there is a sovereign debt restructuring mechanism, which is done by the Paris Club and by the IMF, which is working on these issues. There are many people involved in doing this to resolve these issues, but there is progress being made in all these countries. Okay. Hardik says, sir, how is the Phillips curve relation expected to behave during these times? As I learned, that relationship has weakened over time. That is true. The Phillips curve is a relationship between unemployment and inflation, right? Is that if you have higher unemployment, then people are looking for jobs. Therefore, they are able to give lower wages, and that reduces inflation. Now, actually, Lord Meghna Desai has written an excellent paper on this, showing that the Phillips curve was relevant for a certain period. It is not a universal finding. It doesn't apply at all points, at all periods. So you're right that the trade-off between unemployment and inflation has fallen. Trade-off meaning that you cannot have high unemployment and get inflation down. Okay. And in some ways that's working for the US right now, where unemployment is very low, but inflation is coming down. So the fact that the Phillips curve is flat is actually helping the US in getting inflation lower. Okay, what other questions? What do you think about the effect of tourism industry of India in the future on the economy? Yes, it's a very important industry. You know, we need to attract more tourists. That gets more foreign exchange, creates more jobs. You know, in Thailand, 17% of GDP is tourism. Okay, in India, it's minuscule. You know, a very, very small part of our GDP. So yes, we need to encourage tourism. We need to create that infrastructure first, right? So it can be a big part, but you know, that's true for many, many industries in India, not specific to the tourism industry. Okay, what is the question that Arjav asks? US Congress raised the fiscal debt limit again. What is your opinion of the long run implications? Until when can they continue to do so? How many people know that the US had a credit downgrade by Fitch because of this? Did you read that in the papers? The US credit rating was downgraded because they are continuously bumping against these debt ceilings, and they continuously have to go to Parliament or Congress to get that debt ceiling raised. You know, it's just political brinkmanship, doesn't help. It hurts the bondholders of US bonds, and therefore there was a credit downgrade actually. So I don't think that's going to stop, because that's the nature of the politics between the Republicans and the Democrats. But the US is paying a price for this, and bond yields are higher because of that. Okay. What else? China would love to colonize Sri Lanka and Africa through debts. That's neo-colonization. Dhruv, I think it's more subtle than that, right? China is still not a very rich country. You know, they lent the money because they needed to get higher interest rates, higher returns. Sri Lanka and Ghana and other African countries are paying them higher returns on the investment. It's as simple as that. You know, they just needed to they wanted to get more bang for the buck, right? If you have a $3 trillion in reserves, which China has had, now it's come down, what would you do with that money? If you put it in US treasuries, you got 0.5%, 1%, 2%. If you lend it out to Sri Lanka, you got 6%, 7%. So, you know, if you are smart, what would you do? You would lend it at 6, 7%, right? With a guarantee that it's going to be repaid. Plus, you get a lot of influence in the country, as you're right. You get to, you know, dictate some policies. You can help your businesses to invest in that. So why would China not do that, right? Every rich country, or every country which has surplus, wants to do something like that, right? It's exactly what a rich family member in a family would do. You know, okay, you need some money, I'll give it to you, but you have to do X, Y, Z for me, right? That's how it works. That's how the world works. That's how the US lent money to a lot of countries. That's how England, when it was a colonial superpower, lent money, right? It gave money and bought assets. The entire oil industry was done by England giving loans to the Middle East and buying all their assets, right? That's the way British Petroleum was formed. That's the way the American gas companies, oil companies were formed. So that is just how the world is, right? If you are richer, if you have more surplus resources, you will buy assets which are cheaper. And those who are borrowers, you know, like Sri Lanka, like Ghana, have to face the consequences. They have to face the terms because they need the money. Okay. I would not be too moralistic about it, unfortunately. You know, it's just very practical. Yeah, it says, why does Sri Lanka borrow? Because they have no other choice. If you need money, and there's only so much the IMF and World Bank can lend it, right? If you need X amount, you need $1 billion of funding for your fiscal deficit or your current account deficit, and you don't have that money, And if China is there ready to give you that money, you will take it. If there is a cheaper source, they'll go for the cheaper source, but the cheaper source did not exist. And that's why they borrowed from China. The cheapest source of funding is coming from the multilateral institutions, from the World Bank, the Asian Development Bank, from the IFC, from IMF, and so on. But it is limited, So if you have a $1 billion need and 500 million is coming from those institutions at 2%, how are you going to raise the other 500 million? If you were to raise it from markets, it would cost a lot of money, right? So that is why it is important to stop and get it from China. Okay, I think this Geeta, I think we should wrap it up. Given this, we can go on and on, but I think
exactly.
But let me just summarize and say, guys, please read more, okay, about what is happening globally. Please read the financial press. Please read The Economist. Please read what is happening in China, in Sri Lanka, in Pakistan, in the US, because that's going to inform you. It's going to make you better students, better able to understand the drivers of interest rates, inflation, growth, commodity prices, because India is a price taker in all of them, right? If you only study India, you have learned maybe 40% of what you must learn. So it is very important to get a global view to understand these dynamics, what is happening to interest rates, commodity prices, to growth, to inflation. Okay? That's it from me.
Thank you so much, Tusharji. So I'll take this note to officially thank you on behalf of the principal, students and staff at HR College. I'm Dr. Naveen Punjabi, Vice Principal at HR College. Would like to really thank you for taking out time from your schedule and giving us very insightful, intellectually stimulating and very relevant insights on the global economy. You've given very insightful things on the drivers of growth, interest rate, inflation, commodity prices, its impact. You've also taken up amazing question and answers on the Phillips curves and how it's impacting and how things are moving in the global economy per se. So I'm sure that students have really got a global view of the entire economic landscape and the future trends in it. We also thank Dr. Bhagyashree Dabke for organizing this session and getting Tusharji on board. And overall, we cherish this partnership as HR College and Lord Meghnad Desai Institute. This session has been happening every year and the students are getting a lot of insights from these sessions. We thank Dr. Geeta Nair, the head of Department of Economics, the head of Research Cell and PhD supervisor for getting this collaboration in place and helping us take this forward. Dr. Jahangir Barucha, Senior Most Faculty in the Department of Economics, Dr. Saleha, and all the members of the Economics Department for taking this forward. And of course, students, I think what Tusharji said, please keep reading, and there's no substitute to that. So that's one thing that you should have it as a takeaway, because these sessions can only have value add once you have read the basics in it. So I concur with his views more than 100% if I can, that you must read the financial news dailies every day. So with this note, we thank you so much on behalf of our principal and everyone at HR College.
Thank you, Naveen. Let me also thank on behalf of Meghnad Desai Academy, to HR College, the principal, Dr. Geeta, Naveen, you of course, and all those who are involved in arranging this session. I was also listening to it, and it's always a feast listening to Dr. Podar, because his sessions are backed with so much of detailed data and contents. So we all of us really enjoy, and I think students also have enjoyed. So yeah, and looking forward for engaging more with HR College. Thank you so much.
Thank you, everyone.
Thank you, and a happy convocation ceremony for you all. Yeah. All the best. Yeah, see you soon.
Good.
Bye.
Happy, Geeta, if you would have come.
Yeah, but I have this wedding of my niece, so thank you so much. Yeah, next time. Yeah, bye. Take care.
Bye, Naveen.